Guys, today's video is about why the bank may decline your loan. By the end of this video, I'm going to share with you some common reasons why your loan might get declined and how to avoid it. And if you haven't already, subscribe down below to keep up to date with all things property and finance. Let's start with how we've seen bank decisions affect one of our clients firsthand. Demi is the first homeowner we'd recently assisted with purchasing. When Demi had initially inquired, she was looking to go to auction. So we'd successfully secured a pre-approval to be auction ready. Unfortunately, she had no luck and was unsuccessful at the auction. But luckily enough, she found another property shortly after that. The property went through a private treaty, which meant she was able to include a 14-day finance clause in the contract. And because we'd only just completed the pre-approval, we were able to get the application moving nice and quickly with the bank. As we only recently had the pre-approval secured, the application was subject to a bank valuation and approval from the lender's mortgage insurance. This is where things fell apart. You see, the bank completes a valuation as part of their due diligence process. In that valuation, the valuer leaves risk ratings and comments. When the bank had received the valuation for Demi's purchase, the valuer had left high risk ratings on their valuation report, which meant the bank's lender's mortgage insurer knocked back the application due to the property being an unacceptable property to them. The good news here is we were able to go to another lender that was able to approve Demi's loan. They had no dramas with the valuation and were able to provide a competitive offering in line with what we already had received through the first lender. With that in mind, here are 9 ways you might get declined. Number 1, under 12 months in your job. Lots of banks want to see you in your current role for at least 6 to 12 months to be able to let you lend with less than a 20% deposit. In other words, if you're borrowing more than 80% of the property, so you have lender's mortgage insurance, your loan might get declined. Unless you work with a mortgage broker that knows which banks will lend to you if you're in your job for less than 6 to 12 months. We work with some lenders that will lend even if you've been in your job for a very short time. Number 2, bad credit history. A bad credit history in the eyes of the banks involves small defaults, bankruptcies, and judgments on your credit file. If you haven't seen your credit file, you can check it out through Equifax's website and request a free copy. Defaults on your credit file as small as $100 can cause your loan to be rejected by a bank. As an example, we'd recently had a first homeowner who had a small bill that was actually sent to their old address. They'd moved and never paid this bill. The first homeowner never received the bill and wasn't notified it was overdue because all the mail was going to the wrong address. As a result, the phone company put a default on their credit file for the amount owing. The first homeowner didn't become aware of this until they tried to apply for finance through their bank and actually got knocked back. Fortunately, they came to us and we were able to help them navigate around it and find a lender that would help them buy their dream home. Having a black mark against your credit file doesn't necessarily mean the end of the world, and your loan might not get declined. Number 3, being a difficult property. This used to be the case if you were buying a unique property with a helipad on it. Unfortunately, the banks are even more particular with the types of properties they'll lend on nowadays. Some lenders have restrictions on units, whilst others have restrictions based on bushfires and flood restrictions. In other cases, some lenders will be okay to lend on apartments, but will have restrictions based on either the suburb or the postcode where the unit is located, sometimes restrictions based on high density or inner city locations, sometimes with restrictions when the property has 4 or more stories. The total floor area inside the apartment with restrictions if it's less than 40 square meters, if the lender already has too much lending in that building that you're wanting to buy. Regardless of the limitations, you can still get a loan approved by going with a lender that's happy with this type of property. Number 4, being aged 45 years and older. Although there are anti-discrimination laws to make sure banks don't discriminate on you because of your age, these days it's common for the banks to ask for an exit strategy in paying off your loan if you're 45 years or older. In effect, these restrictions can limit your mortgage options because of your age. Whilst different banks have different policies, some common exit strategies for anyone aged over 45 is moving to a smaller house and downsizing once you reach retirement age, selling other investment properties or shares, releasing funds from your superannuation to pay down the loan, recurring income received from your superannuation. Number 5, spending habits. When you apply for a home, nearly all banks want to see the last 3 months' day-to-day transaction statements. If you spend a little too much at Zara or Dan Murphy's on the weekend, this could affect your loan application. The banks will look at your monthly living expenses to determine if you can afford to meet your home loan obligations. Number 6, small deposit. These days, you'll need 8 to 10% of the property value saved up as a deposit for your home loan. But there are situations where you can use a guarantor to help you borrow up to 100% of the property value plus additional costs. Best of all, you can avoid paying lender's mortgage insurance, which is usually payable when you have less than a 20% deposit. Banks all have different lending criteria and policies, and a small deposit to one bank might be completely fine to another. Number 7, being too young. Don't worry, young people get grief from banks here too. You can't apply for a home loan if you're under the age of 18 years old, but you might not have realized that being under the age of 25 can also negatively impact your credit score. Being young, you may have a very limited or no credit history to show that you're a good borrower to the bank. The good news here is that not all banks credit score, which an experienced mortgage broker can help you understand and navigate around. Number 8, too many loan applications. If it wasn't enough being too young, too old, and looking at a unique property, the banks regularly decline home loan applications if you have too many inquiries on your credit file in the last 12 months. In other words, if you had more than 2 to 3 credit inquiries in the last 6 months, the banks could knock you back for having a bad credit score. Fortunately, there are banks and lenders out there that will consider your application provided there's fair reasoning for the recent inquiries. Number 9, being self-employed. In a lot of cases, the banks will decline your loan being self-employed if you have less than 2 years tax returns. We work with several lenders that will consider home loan applications with people who have been self-employed for only 12 months. There are a lot of mortgage brokers and banks who are generalists and find self-employed applications all too difficult. Here at Hunter Galloway, we have a team of credit experts who will help find that lender that'll work for you. So what's preventing you from qualifying for a home loan? Here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a mortgage broker, we can help. Visit us online at huntergalloway.com.au or call us on 1300 08065 and we'll see you next time.